Hello and welcome to Virtual Investor Conferences. My name is Phil Carlson, and on behalf of KCSA Strategic Communications, as well as our co-host OTC Markets Group, we're very pleased you have joined us for a fireside chat with SNDL, one of the largest vertically integrated cannabis companies. Their session will be moderated by Frederico Gomes, Director of Institutional Research with ATB Capital Markets. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Scheduled Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Zachary George, Chief Executive Officer of SNDL Inc., which trades on the Nasdaq under the symbol SNDL. Welcome back, Zach and Frederico.
Thank you, Phil. Good morning. How are you, Zach?
Good morning. Thanks, Phil. Hi, Frederico.
Okay, so maybe let's just jump right into it. Zach, SNDL has recently reported the 2022 results, the Q1 23 results. So maybe could you talk a little bit about a couple of key takeaways from those earnings and where the business is right now?
Absolutely. Thanks so much for the question. The last 2 years have been extremely busy for the company, and as you followed our acquisitive growth path, we put up or recognized significant financial and operational milestones in 2022. Exiting the year, we put up record net revenue, which has grown by over 1,000% year over year, and generated net cash from operating activities in the fourth quarter at a record level as well. So as we have described to investors, we're expecting some noise in the first half of this year as we've integrated Balance and are simplifying our operating footprint and looking to lean out our manufacturing operations. But we're really excited about the initiatives that are underway currently at the company, and we expect those to drive step function change in terms of margins and profitability in all of our segments into the back half of this year. Also noteworthy is the excitement we have around the Balance acquisition, which has enabled us to enhance our cannabis operations and the value proposition therein, which now includes premium cultivation, low-cost biomass sourcing, processing, and manufacturing. So the intended results of our vertical integration mission are playing out as expected, and we're excited to share our results with investors through the balance of the year.
And talking about a little bit of your manufacturing and cultivation footprint, so you have announced, some rationalization measures in respect to your old facility, as well as some of your assets that you acquired with Balance. So how does your facility footprint look like now, and what impact do you expect your rationalization to have on margins this year?
It's a great question. I would just start by backing up and really recognizing that we've gone through a period of extremely rapid growth and transformation over the last 2 years. And at this point, we're keenly focused on integration opportunities, improvements in broader efficiencies in our operations, and margin expansion, which we see as an opportunity across both our liquor retail, and cannabis operation segments. So we've successfully now migrated all of our processing activities from both Atholville, New Brunswick, and Olds, Alberta, into our Kelowna processing and manufacturing complex. That was no easy feat. And so the team has done a great job under the leadership of Tyler Robson in achieving that end. We also have a dedicated beverage manufacturing facility in Bolton, Ontario. So what you see today is really reduced activity at 2 dedicated cultivation sites in New Brunswick and Alberta, increased capacity utilization at our complex in Kelowna, and then, as I mentioned before, our beverage operation in Bolton, which we're really excited about for this summer as we start to see the category wake up and show some signs of life going forward.
And in terms of pursuing any other meaningful cost reduction measures or asset divestments this year, do you anticipate anything?
We've spoken publicly about our increased expectation in terms of synergy opportunities that should be north of $30 million. So we're very excited about that. We expect to realize on the majority of that balance within this calendar year. We've already realized over $13 million in cost savings, and that number continues to climb with the balance that should occur in 2024. And that's partially a function of our transition to a much more aggressive approach and reliance on procurement, and our need to manage our cultivation and depletion of inventories for the time being as we move through that transition. When you think about, again, the rapid growth that we've experienced over the last 2 years, which has involved capital deployment, a lot of investment, we're now in a position where we can start to clean up after we've built the infrastructure and have the requisite scale to get to profitability with our existing model. So that means that you'll likely see us liquidate and monetize smaller investments. We have a handful of small real estate assets that are in various stages of being sold. These are small assets worth anywhere from, say, $1.5 to $5 million. So you're going to see pockets of liquidity and value unlocked through the monetization of assets. And given where we're trading today, we think that there are much better uses for that capital to deploy either into the business or to return capital to shareholders.
Okay, that's interesting, and we'll get into that in terms of capital allocation. But just regarding your cannabis operations in Canada, we know it's a difficult environment with price compression, etc. And you have done a lot of acquisitions. When do you expect to achieve sustainable profitability within that segment? What steps? I know that you've talked about the integration here, but what other steps are you taking to ensure that you get there as soon as possible?
Quite simply, Fred, just to run you through an example without giving too much guidance. Clearly, the mission for us is free cash flow generation. We've talked about looking to reach that objective by the end of this calendar year. But I think it's important to understand the drivers and some of the challenges that we've had over time in our cultivation operations. And some investors and participants may ask, with a business that's pro forma doing north of 100 million in revenue versus your much larger retail components, is it worth the focus? And what I would say is that in the cannabis operations segment, it probably has the biggest opportunity for improvement and lift in terms of operating cash flow. So the example I would use is that if you kind of refer to the budget that our team would have presented to our board last year in November for 2023, we envisioned a plan that was conservative and involved the sale of approximately 30 million grams of flower, and this would have been, again, pre-valence. And with the nature of our cultivation assets and power price volatility in Alberta, we've seen cash cost of cultivation be as high as $250 or even higher for moments in time. And the opportunity to take advantage of Canadian oversupply through a strong procurement strategy means that we should be able to drop $1 or more a gram out of that cost structure. So on a 30 million gram plan, you can imagine how powerful and compelling that is. So we're really excited about some of these opportunities. We also are, I would say, subscale in a few of our product segments. I would point to edibles specifically. And so we think that market, and particularly the regs that exist in Canada, are going to change in the intermediate term and really open up opportunities for us there as well. And we're excited about the prowess that we can bring to improve distribution through both our owned and managed retail, but also with retail partners across the country.
So to that point, you mentioned your retail exposure. You have a proposed arrangement with Nova Cannabis. Can you talk a little bit about that? Know what role it plays within your broader strategy, and how you believe it can benefit your shareholders?
Sure. So we proposed a strategic partnership with Nova back in December of 2022. In May, we received overwhelming support from the minority shareholders of Nova. That vote came in with over 99% support. And our objective here is to create a well-capitalized, pure-play cannabis retail platform that provides for vertical integration opportunities to leverage both our upstream and downstream capabilities at SNDL. So the transaction has an outside date of June 30th. I know that investors are questioning the timing of the required dividend of securities that we're working on. And so we're just waiting for final provincial regulatory approval to announce the timing and specific terms of that dividend. So we expect to be able to make an announcement on this in the coming weeks.
Okay, and just going back to Canada and prices, can you talk a little bit about what are you seeing in terms of, we've seen a lot of price compression over the last couple of years, but are we close to prices bottoming, both, within your cannabis operations on the cultivation level, but also on the retail side? Can you talk about those two markets and what are you seeing on the pricing side?
Absolutely. So I've written and spoken about this in some detail, but it is my view that the Canadian market is troughing currently. Always difficult to pick the bottom, but certainly you're seeing a requisite level of attrition, business failure, and in pockets a reduction in supply that's going to take some pressure, off this market. In addition, the proliferation of retail licenses has, I think, in many markets in Canada reached a saturation point. And you're seeing unprofitable operators pull out of the market or seek to aggressively restructure to eliminate liabilities. And we saw that this week with the CCAA filing of Fire and Flower, for example. So very excited about the marketplace. We are actually taking price in select areas where we think that this race to the bottom has been overdone. And we're seeing retailers, even those retailers focused on managing to very tight gross margins, playing in a value or discount space, start to push the envelope and lift price ever so slightly at this stage. So, and having some success in doing so. So the industry is maturing. There's still certainly a lot of growing pains. It's far from healthy in Canada, but I do believe that we are absolutely in the troughing phase today.
Okay, I want to move a little bit away from Canadian cannabis and maybe just talking about your investment segment. Can you provide just a brief overview of the investments you currently have, especially in the US with with SunStream?
Absolutely. So, Frederico, as we've discussed, we have a joint venture with a SAF group that's called SunStream Bancorp. That effectively is a credit portfolio that is worth just over $500 million Canadian, and we have exposure to 6 different credits. We've spoken about this again on numerous occasions. So those credits include Ascend, Jushi, Columbia Care, AFC Gamma, SkyMint, and Parallel. And the U.S. market is going through, in various states and jurisdictions, its own cycle right now. So we've seen a lot of volatility in terms of credit quality, and companies struggle to both refinance debt or raise equity, as the industry is currently, effectively being starved of credit and equity capital. So it's certainly interesting times, and we continue to believe that the best risk reward in the sector today is actually in credit. So we're happy to be a non-control participant in that joint venture, which remains compliant with our Nasdaq listing.
And can you share anything about the the restructurings that you have mentioned before on some of your portfolio in terms of potentially getting more direct exposure to the US through those restructurings?
Absolutely. So we have mentioned the fact, and this is all publicly available through court documents and other sources, but both SkyMint, which is a Michigan operator, and Parallel, which is a multi-state operator with a presence in Pennsylvania, Massachusetts, Florida, and a license in Texas, are going through their own restructurings. We don't have any detail to provide beyond what's in the public domain today. I would say that we're expecting court dates to occur for these companies, even inside the month of June. And we should get more clarity on the timing of restructuring and potentially court-managed auction processes, if that's what's in the cards. So we're gonna strive to provide updates to our stakeholders on a timely basis as that information becomes available. But what I would point to in terms of potential future optionality, we have a good relationship with our primary exchange, which is the Nasdaq. We take compliance extremely seriously. We are prohibited from engaging in plant touching activities in the U.S., and so we'll not be engaging in those activities in order to preserve our current status. That being said, it's noteworthy that you can see that, for example, a few companies are really breaking trail in regard to compliance structuring on a cross-border basis in this industry. One would be Cannabis, who has reached agreement with Nasdaq on a compliant USA Corp structure, which will enable them to realize on some version of consolidation for assets that they have exposure to in the US. And then you also have companies such as TerraSend and others looking to uplist to the TSX, which could create quite a following and action there too. So when you think about the family of companies that we're involved with here, you've got SNDL with a Nasdaq listing and a potential path to compliant ownership or involvement in US businesses. And then also when you look at Nova and their TSX listing, that creates quite a bit of optionality for the future in terms of potentially managing cannabis retail licenses in south of the border at some point in the future.
And are there any additional U.S. investments, whether be equity or debt, which you said you prefer, that you are currently looking at for this year potentially? How much additional capital are you willing to allocate to the U.S. at this point?
It's a great question. We do expect to invest in certain restructuring activities should they be required. We've talked about potentially investing as much as $20 to $40 million in existing portfolio companies to shore up operations and ensure that they are generating free cash flow and stabilized. That being said, I would say that we've seen widespread credit deterioration in the space. You only have to look to some of the bonds that are trading in the market from some of the largest MSOs, including say a Curaleaf or a Trulieve, that are now implying yields to worst on their credit in the high teens. And I think that really speaks to just how challenging this environment is for companies. And so I would not expect us to be deploying capital at any significant scale into the US beyond managing our existing assets at this point. I would say never say never, but we've been extremely busy over the last 2 years, and we're really looking to unlock value from our existing asset base instead of looking out and rushing to deploy more capital into the US at this point.
Thank you for that. Moving on, maybe just on your liquor retail segment, moving away from investments. I think so that's an interesting segment. Alcanna, what are the growth opportunities you see in that market? How has seasonality impacted recent results? And how are you trying to execute on some of the growth opportunities in that more mature market than cannabis?
It's a great question. And first off, I would just say that the operating infrastructure and team that joined us with Alcanna has been absolutely instrumental in giving us conviction and strength as we build out our cannabis retail segment. On the liquor side, there's a few opportunities that have emerged even recently that weren't really open or available to our leadership team on the liquor side historically that we're quite excited about. And so while we have a meaningful share in liquor distribution in Western Canada, we're now seeing a trend across a number of provinces that are looking at privatizing what are currently government-managed liquor retail and distribution networks. And so we actually, in a government auction, were awarded 2 licenses in Saskatchewan, which we're really excited about given the lack of liquor store density in that province. There's even noise around the potential future for Ontario to look at privatizing its liquor operations as well. So those create potential opportunities for the future, but more than anything, Frederico, we're looking at opportunities in the here and now to improve results. Our teams have been very prudent around managing capital and ensuring that we take every opportunity to lean out our inventories, but also the opportunity to sell data as a service and monetize the extremely valuable point of sale information that we have, and use that to enhance and improve efficiencies with supplier operations, is a big opportunity that has only opened up to us recently. And so we expect that to help improve margins along the way. So we're really looking at opportunities that we believe could increase our gross margin profile by as much as 200 or more basis points, which is really exciting when you think about the potential cash flow impact that may have.
So to that as well. So in your last results, you mentioned that margins in that segment had improved to 24% in April from 23% in the previous quarter. So you expect those margin improvements to occur pretty rapidly given your initiatives?
I guess it depends how you define rapidly, but I think that we can demonstrate our ability to execute on this in a period of the next 2 quarters. And again, your initial question, pointed at the seasonality in the business. I think that many retail investors don't understand that. This is nothing new. Anyone who traffics in the space understands that sales typically with the holiday season at year end tend to peak, and Q1 is the quietest. So we're building up into some very strong summer months. Obviously today, with weather being impacted by fires across North America, we may see some change in buyer behavior, but we're expecting to see sequential growth starting off of a lower base in Q1, which is seasonally modest and absolutely expected, and is nothing new, to a crescendo late in the year. And if we can deliver improved margins on that sort of peak seasonality, we should see great cash flow conversion, which investors will appreciate.
Okay. Looking at the international market for cannabis, can you remind us of your current exposure to those markets, and would you consider deploying capital towards investing in international medical cannabis in Europe, for example?
It's a great question. Look, we're really trying to build the strongest platform that exists in Canada today. So I would start with the accomplishments that both legacy SNDL and the legacy Valens teams have had in terms of exporting flower internationally. That opportunity still exists. You've seen a number of our peers and competitors ship reasonable volumes to Germany, Israel, Australia. We've shipped product collectively to both Israel and Australia, and have a number of ongoing discussions that will increase those volumes over time. What's interesting is the oversupply that exists in Canada today means that you can actually access grade A flower and beyond at prices that in many cases are well below the marginal cost of production. So those attractive prices, I think, will attract international importers and may solidify the relationships that Canada has with international markets for some years to come. And so while there's this narrative that ultimately the export from Canada will be short-lived and will likely be replaced longer term from cheaper outdoor production or hybrid glasshouse production from say Colombia or Portugal. The mere fact that we've got such oversupply and very, very attractive flower prices means that the opportunity for Canada may persist longer than some might think.
So we have an additional 5 minutes here, so I just want to go into some of the questions from the audience. First question here, what are the catalysts for growth and profitability that investors can look forward to over the next 6 months?
You know what? I really like this question because I can tell you that we're expecting growth and improved cash flow and profitability in all of our segments. And we're working to simplify our asset mix and balance sheet. Our teams are focused on all the right things in terms of creating long-term value and doing things the right way. We intend to be here for the long term and be a really critical part of this industry in Canada. So we're expecting through various initiatives to see improved cash flow and margin expansion in our liquor retail ops into the end of the year. Some very exciting initiatives happening with our retail cannabis portfolios, is led by Marcy Kiziak. So we're expecting margin expansion there as well. We've opened a few new doors organically, and we are going to continue to see pockets of distressed but performing retail come up for potential acquisition. So we're getting calls right now daily from operators who are looking to exit and sell us their retail. In many cases, most cases we're saying no, but there will be a couple opportunities that do come our way. And then in cannabis ops, I believe we're going to show just very dramatic step function change in terms of our margin profile, largely driven by two main factors. One, getting away from higher cost cultivation exposure, which has been a stubborn factor when you look at Olds and the cultivation footprint that I inherited, but also through stronger capacity utilization and the rationalization of our broader SKU portfolio, which is happening as we speak.
And looking at your balance sheet and from a capital allocation perspective, you have no debt and you have over 100 and close to 190 million in unrestricted cash as of your last reporting. So how do you view those opportunities and where do you intend to deploy that cash?
It's a good question. Look, what I would say is when it comes to making investments, we do have a few more items, capital items that you'll see us invest in that are largely immaterial, but they'll bolster our manufacturing efficiencies, packaging automation, etc. But we're really focused on maintaining one of the strongest balance sheets in the space, which has served us very, very well. And so being conservative, but when you really look at our valuation and you look at our credit portfolio plus our cash balances relative to where our market cap is today, you can really make the argument that we're getting no credit for diverse operations that are generating over $1 billion in revenue. And on that basis, there's really no loan that we can invest in or deploy capital into that will generate a better return than the repurchase of our own shares. And so really looking to make sure we have max conviction on getting to sustainable free cash flow and using that conviction as an opportunity to return capital and shrink our float going forward, which will drive NAV accretion and better per share metrics.
Thank you. And just one last question here before we finish. How should investors look at your valuation right now? I know that you think it's attractive, but do you see any catalyst regulatory wise that could happen anytime over the near term and help stocks in the sector? Zach? Oh, I think we lost connection here, so I think that concludes our session.